Hey everyone, welcome back to Trek for Wealth, the podcast where we talk about money the way real people actually talk about money. I'm Avery.
And I'm Grant. And Avery, I have a word for you today. A word that makes economists very uncomfortable. A word that was everywhere this week on Wall Street.
Okay, what's the word?
Stagflation.
Okay, I've heard it. I've seen it in headlines, but I want to be honest, I'm not totally sure I could explain it to someone at a dinner party.
You are not alone. Most people have heard the word. Far fewer can define it precisely, and almost nobody understands why it is genuinely the most feared economic scenario for policymakers. More feared than a regular recession. More feared than inflation on its own.
So let's fix that today, because the word is everywhere right now for a reason. This week, Chicago Fed President Austin Goolsbee said rising unemployment on top of an oil price shock creates, quote, exactly the kind of stagflationary environment that's as uncomfortable as any that faces a central bank.
On Monday alone, at least 6 notes from investment managers and Wall Street analysts used the word stagflationary. Mohamed El-Eriani, one of the most respected macroeconomists in the world, warned this week that the Iran conflict could push the global economy into a fresh bout to stagflation.
And Jerome Powell, just 2 days ago at his press conference, had to address it directly.
He did, and what he said is very revealing. Let's get into it.
Okay, Grant, start from the beginning. What is stagflation? Plain English.
So, stagflation is 2 bad things happening at the same time, when conventional wisdom says they can't.
Which 2 things?
Inflation, prices rising, and economic stagnation, growth slowing, unemployment rising. Normally, these 2 things pull in opposite directions. When the economy slows, prices tend to fall. When prices rise, it's usually because the economy is growing strongly. Stagflation is both happening simultaneously, and that creates a nightmare for policymakers.
Because the medicine for one makes the other worse.
Exactly. If you want to fight inflation, you raise interest rates. Higher rates slow borrowing, cool spending, and bring prices down. But they also slow economic growth and kill jobs. So if the economy is already weakening, raising rates makes the recession worse.
And if you want to fight the recession,
You cut rates. Lower rates stimulate borrowing, boost spending, create jobs. But they also add fuel to inflation. So in a stagflationary environment, every tool the Fed has makes one problem better and the other problem worse. There is no good move. That's why it's the nightmare scenario.
so it's not just bad, it's bad in a way that's specifically designed to break the tools we use to fix bad things.
The Federal Reserve literally cannot win, and Jerome Powell acknowledged this 2 days ago. He called it, quote, tension between the goals. Core inflation running at 3%, above target, job market weakening, 92,000 jobs lost in February, and now an oil shock threatening to push inflation even higher at exactly the moment the job market needs support. He's stuck.
And he said something else that I thought was fascinating. He pushed back on the 1970s comparison directly. He said, quote, when we use the term stagflation, I always have to point out that that was a 1970s term at a time when unemployment was in double figures and inflation was really high. That's not the situation we're in.
Which is both accurate and a little reassuring. So let's go to the history, because understanding the 1970 stagflation is essential to understanding why economists are so alarmed by the word, and also why some of them are saying this time is different.
Take us back, Grant.
So the 1970 stagflation had a very specific origin. It starts with President Lyndon Johnson in the late 1960s. He dramatically increased government spending, the Great Society domestic programs, and the Vietnam War simultaneously, without raising taxes to pay for it. That created underlying inflationary pressure.
So inflation was already building before the oil shock even hit.
Already building. Then, 1971, Nixon takes the dollar off the gold standard. We covered this in episode 6. That devalued the dollar and added more inflationary pressure. Then, 1973, the OPEC oil embargo quadrupled oil prices overnight. All 3 forces, government spending, devalued dollar, oil shock, hit at the same time. Inflation explodes from 4% to 14%. Unemployment climbs, the economy stagnates, the classic definition of stagflation.
And they didn't just go away.
It persisted for almost a decade, through 1979, when the Iranian Revolution triggered another oil crisis. Prices doubled again. Inflation hit 14.8% in March 1980. Unemployment reached double digits. People were genuinely wondering if the American economic model was broken.
And the solution, which we covered in episode 3, was Paul Volcker's brutal rate shock.
Rate shock. 20% federal funds rate, mortgage rates at 18%, 2 recessions, massive unemployment. It took almost a decade of pain to break the back of stagflation, and it scarred everyone who lived through it, which is precisely why economists get so alarmed when they even hear the word today.
So how close are we right now to that scenario?
This is the honest, nuanced answer. JPMorgan's chief global strategist David Kelly said this week, and I love this quote, "If you want the word stagflation with a very little s, you could." He revised his growth projections slightly downward and his inflation projections slightly upward, but he's explicitly not comparing this to the 1970s.
Why not?
Several important differences. First, the U.S. economy is far less oil-intensive than it was in 1973. Services dominate now. Technology, healthcare, finance, these sectors don't get crushed by oil the way manufacturing did 50 years ago. Second, there's no wage price spiral today. In the 1970s, powerful private sector unions negotiated cost of living increases. When prices went up, wages went up, which pushed prices up more. That spiral is what made the inflation so persistent. Today, wage growth is actually slowing for most workers. The spiral mechanism doesn't exist the same way.
And third, the Fed has more credibility today than it did then.
Significantly more. Because of Volcker's brutal medicine in the 1980s, the Fed established a track record of fighting inflation at any cost. Markets believe the Fed will act. That belief itself keeps inflation expectations anchored. In the 1970s, nobody believed the Fed would do what was necessary, so inflation expectations became self-fulfilling.
Though the honest assessment is not the 1970s, but not nothing either.
One Wall Street firm put the odds of a full-blown 1970s-style stagflation at 35% for the rest of 2026. Base case is still normal growth, 60%. But 35% odds of something seriously uncomfortable is not a number you should sleep easily through.
And the variable that determines which scenario plays out?
The Strait of Hormuz and the duration of the Iran war. If the conflict resolves in weeks, the oil shock is a bump. If it drags on for months, the historical parallels become much harder to dismiss.
Okay, practical. What do you actually do if stagflation arrives or deepens?
So here's the fascinating thing about stagflation investing. The assets that win are almost the opposite of what wins in a normal bull market. And history from the 1970s is actually very clear on this.
Walk us through it.
The winners in 1970 stagflation, the assets that actually grew in real terms, were gold. We covered this in episode 4. Gold went from $35 to $850 during that decade, a 2,300% gain. Real estate, property values, and rents rose with inflation. REITs gained 100% in total return between 1971 and 1981. Commodities broadly, energy, agriculture, raw materials. Energy stocks, specifically, while the S&P 500 essentially had a flat decade in real terms, energy companies posted record profit.
And the losers?
Traditional stocks, especially growth stocks, technology, consumer discretionary, companies that needed cheap borrowing costs to grow got destroyed by rising rates. Long-term bonds absolutely crushed. When inflation runs hot, the fixed payments of long-term bonds become worth less and less in real purchasing power. If you were holding long-duration bonds through the 1970s, you lost significant real wealth.
Which is why the all-weather portfolio we discussed in episode 7 actually matters so much right now.
Exactly, because an all-weather portfolio is already tilted towards the assets that survive stagflation. Gold, commodities, shorter duration bonds. It's no coincidence that Dalio designed it after experiencing the stagflation era firsthand.
Okay, 3 specific wealth moves for a stagflationary environment.
Move 1. Tips. Treasury inflation-protected securities. Their principal value literally rises with inflation. If inflation runs to 4 or 5%, your TIPS principal grows with it. They are the most direct way to protect purchasing power in a stagflationary environment. They don't make you rich, but they don't let inflation steal your savings either. You can buy them directly at treasurydirect.gov or through bond ETFs like SCHP or STIP.
Move 2. Check your bond duration. This is a less obvious but critically important one. If you have long-term treasury bonds in your portfolio, 15 to 30-year duration, rising inflation is their enemy. Consider shortening duration. Move toward intermediate or short-term bonds. The potential pain from long-duration bonds in an inflationary environment can be severe and historically underappreciated.
Move 3. Don't abandon stocks entirely, but shift toward defensive sectors. In the 1970s, consumer staples, healthcare, and utilities outperformed significantly. People still bought food and took medicine and used electricity even when the economy was struggling. Companies in these sectors have pricing power. They can raise prices to maintain margins when costs go up. ETFs like XLP for consumer staples and XLV for healthcare are straightforward ways to get this exposure.
And the meta move, which ties back to every episode of Trek for Wealth, don't make dramatic, panic-driven portfolio changes based on one scenario. The same Wall Street firm that puts stagflation odds at 35% puts normal growth at 60%. Prepare for the possibility, don't bet the farm on it.
Preparing without predicting. Always.
Always. Always. Grant, close us out. One sentence.
The 1970s didn't happen because stagflation is inevitable. It happened because policymakers were unprepared, oil was a much larger share of the economy, and workers had enough bargaining power to turn an oil shock into a decade-long wage price spiral. None of those exact conditions exist today, but that doesn't mean today's version can't still hurt. It just means the medicine, if needed, is likely to be faster and less brutal than what Volcker had to do.
Stagflation with a small s. That's what JPMorgan called it. And a small s stagflation is still something worth preparing for, which is exactly what Trek for Wealth is here to help you do.
Episode 10, we made it.
We made it. That's Trek for Wealth, everyone. Thank you so much for being with us on this journey. If you've been listening since episode 1, you now have a genuinely comprehensive understanding of how the global economy works and what to do about it.
Share this episode with someone who keeps hearing the word stagflation and doesn't understand why it makes economists go pale.
We'll see you next week. Keep tracking.
Take care, everyone.